So let's kick off. Hi, everyone. My name is Dmitriy Berenzon. I'm a research partner at Bollinger Investment Group, and we are doing a really interesting session today on fairness and fairness in the context of DeFi and trading, and really talking about why it's important, how is it implemented in traditional financial markets, how can we implement it in a blockchain context, and we have some really exciting folks to talk about this with us. We have Klaus and Tamlyn from Vega Protocol, and I personally think this is a relevant topic, particularly today, really looking at what's going on just on Ethereum with the issues around front running, miner extractable value, attacks on DeFi protocols. And I think this all points to a future where fairness will be increasingly more relevant and more important to get right. So what we're going to do is really explore that. We're going to kick off with a 5 to 10 minute presentation and discussion that's led by Tamlyn, and then we're going to dive into about 30 minutes of discussion, and we're going to have a 15 to 20 minute Q&A at the end. But with that said, I think we want to make this as interactive as possible. So for those who are on live, if you have any questions, please feel free to post it in the chat box, and we'll try to get to it as they come in. But don't be shy. I think we want to make this as deep and interactive as possible, and really ask the tough questions. So with that said, let's do quick intros. Like I said, I lead research and investments at Bollinger Investment Group. We are a blockchain-focused family office that invests in a variety of protocols, as well as software and financial infrastructure that supports those protocols, and consumer proximate applications that build on top, of which DeFi has been a large focus for us in the last year. All right, Tamlyn, do you want to give an intro?
Yeah, hi everyone. I am Tamlin Rudolph. I am a former energy derivatives trader, and I joined Vega back when the Vega founding team were formed. And yeah, throughout my career in trading, a big part of my job was trying to ingest market information and turn it into sort of trades and positions on a market, whether that was hedging or proprietary trading. And, whether it was dealing with voice brokers or whether it was dealing with the centralized exchanges or any other kind of market mechanism, getting priority access to the order book and thinking through issues of racing and competing with other traders was just so fundamentally important to my role that when I joined Vega, I think it was literally the first conversation I had with our cryptography advisor at the time, George Dinezes. And I was like, wait, hang on a sec, how is this going to work? And, it's been a sort of 2.5 year kind of project that we've had around thinking through fairness and thinking of how we're going to construct a market like a marketplace like Vega that's going to operate in a really well way for professional traders. So yeah, it was super exciting when Klaus joined and he was asking us for difficult problems, and we gave him about the hardest one in our basket, and he went away and came back with some amazing research on it. So really excited to have this chat with you guys today and talk about it all.
Awesome, thank you.
So I'm Klaus, and I started working on what's now blockchain in '98. Back then it was called Byzantine fault-tolerant total ordering protocols, which probably also explains why it never took off this way. Nobody could pronounce that name. Back then, working on fully asynchronous randomized protocols, built the first implementation that would be almost a blockchain, but back then we completely failed to find a business case. So we had great technology, but nobody cared. So I changed topics for a while, then Bitcoin came along, and now I'm back in the area. And the fun thing with Vega is that they have really exciting problems. It's not a blockchain that just does money transfer, which is we pretty much know how to do, but traders have a lot of different problems. They need extremely low latency. We need different staking models. And the one we're talking about now is fairness. So it's a lot of fun research to do. And so I got back and people pay me to do what's fun. So yep, I'm happily trying to push that forward and get a blockchain running that is optimized for trading.
That's awesome. Thanks for that. And yeah, really exciting how both of you come with, decades of experience, super relevant to this. So good. So let's maybe kick off, Tamlyn. You had a couple of things you wanted to talk about. I think this is important because it kind of gives some analogies to how this topic is relevant in kind of traditional financial markets. And maybe let's start off with that and then kind of transition into how this looks like in a blockchain conference. So I'll hand it off to you.
Yeah, great. Thanks, Dmitry. So yeah, I was kind of keen to just share a spreadsheet with you. It's very hacky, but just chat through initially with you guys about just to show you how important the sequencing and ordering of transactions actually is. And so why I was so sort of horrified initially that miners would have this sort of power to affect the sequencing of transactions that go onto a continuous limit order book. So I'll start with that. I'd love to take questions as we go. These are very, very toy examples, but they're just to sort of set the scene around how limit order books can be messed with if you have kind of sort of full discretion over the sequencing. So I'm just going to share my screen and hopefully this looks okay. Can you guys see that?
Yep.
Great. I'm going to keep you guys there because I like to feel like I'm talking to people. That's okay. So I have just designed a very simple, very basic order book. As I said, this is a toy order book with these are the sell orders on the order book that are passively sitting there. So we have some people who want to sell 2,000 at $100. We want some people who want to sell 1,500 of this thing, this contract. I'm not even going to say what it is, at 101, etc. And then also on the buy side, you've got people who want to buy 300 at 99, 5,000 at 98. etc. And so at the moment, you can see there's no one matching here. This is the passive order book. The buyers only want to pay 99. The sellers only want to sell at 100. That's, yeah, the state of the order book as a starting point. So then I wanted to look at a case. All right, I'm going to move the cell away a little bit. I wanted to look at a case, first of all, of when we just, as I said, very toy examples. Just say we had two transactions come in. And one of the transactions was to buy 1,000 and the other was to sell 1,000. And these are market orders. So it's just buy or sell at whatever price. So if we sequence them one way, I'm afraid I didn't update this properly. Oh no, I did. If we sequence them one way, so if the trader 1 transaction went first and then the trader 2 transaction went first, then the trader 1's buy volume would buy 1,000 at 100. So it could go and buy half of this volume that's sitting at 100. And then the trader 2 wants to sell 1,000, so they'd sell 399 and the remaining 700 at 98. Now, if we sequence them the other way, if you have a look here, whilst the sequence of the trades alters, the trades are still the same trade. The trader is still buying 1,000 at 100 and the trader 2 is still selling 300 and 700 at those prices. So really, actually, when you just have market orders, it doesn't really make that much of a difference. You can just batch up all the buy orders and you can batch up all the sell orders and just sort of execute them. Either the buys all first and the sells all first, and it doesn't really matter. Caveat to that, that's for a limit order book. It will matter on AMMs, but I won't get into all of that kind of side of things at the moment because this, all of our sort of designing has been around implementing fair continuous limit order books. So that's case one. So case two, though, we start to get some more interesting things happening. So if we give some traders access to the order book before others. Oh, sorry, I've just kind of messed this up. Actually, I'm going to come back to that one. I'm going to go straight on to case three. Right. This is why you should practice this sort of thing before you do it. I apologize, I'm just getting myself a bit lost. Okay, cool. So if you've got some situations where you are buying 500, you've got a trader 2 wants to buy 3,000, trader 3 who wants to sell a limit order. And now we're going to mess around with the sequencing. Okay, so if we first of all sequence them in this order, we get these trades occur. And I won't go deeply into what's going on here. You can have a look. I'm happy to share the spreadsheet after. But what basically happens is that trader 1 is first getting to buy first, and then trader 2 comes through and they are also buying, and they buy right up to 101. And then only after that does trader 3's offer come in, which is more competitive, and it wants to sell at 100, and it joins the passive order book now. Whereas if trader 3 had been there before trader 2's execution of buying, they would have been able to buy this amount that trader 3 had on the order book. Does that all make sense?
Yeah, I mean, it sounds like the timing is important. I think I don't know if I want to dive too deep into this, but what constitutes a trader's order hitting the order book? Is that connectivity with the exchange, or how does that actually hit the order book itself?
Yeah, so typically in like a centralized exchange, and I've got a couple of tabs here that I'll share with you guys on just sort of how centralized infrastructure works. But yeah, typically for a centralized exchange, the promise of a regulated centralized exchange is that they are processing these in the order that they receive them, which is why traders will pay so much money to position their servers where they're sending the orders to the exchange as close to the actual exchange as possible. And this is a practice called Colocation. And actually, I think it's literally billions a year now that exchanges can charge for this service because of this benefit that you get through gaining priority access to the order book. And sort of another example of it, sorry?
It got to the point that, for example, they use radio microwaves rather than glass fiber because the light speed in air is slightly faster than light speed in glass fiber. So
yeah,
this little amount is already mattering enough for people to invest a heap of money into it.
Yeah. And for anyone on the call who's interested, it's really worth reading Flash Boys that, sort of really talks about some of the kind of arms race, as they like to call it, for the HFT infrastructure. And some really funny stuff that's happened. But yeah, I just wanted to do one more case actually here, which is something that, Dmitry, you sent me through something where people had talked about back running as opposed to front running. So I think in previous or a lot of the ways that I always think about sort of competition for access to the order book is trying to get to the order book first, because a lot of the time traders are ingesting the same information. So whether that information is that you're, a different exchange has traded a different price, or whether it's, a change in a weather reading or some news or whatever it is, the sale of a stock, the company announcement, the race to get to the orders that potentially this order book suddenly gets stale. If suddenly something is going to make this contract spike in volume, everyone wants to grab a bit of this, because it's like you want to grab a bit of this, and then ideally, if you can, you want to turn around and sell it immediately. But something that I think what you sent me through, which was looking at what about the idea behind wanting to immediately follow a transaction, which is absolutely also really valid. So for example, buyers will want to come after sellers and vice versa. So if we had the following transactions, for example, we've got some buyers and a sell limit order. If we organize them transaction 1, 2, 3, we have the traders able to, trader 1 and 2 buying, at, what are we looking at? Sort of the 100 to 101 region. But if trader 3, what have we got? Them wanting to sell at 99.25. So obviously, if this trader 3 has got a really nice competitive offer here at 99.25, if they come onto the book first, then trader 1 and trader 2 are going to be able to transact with that 99.25 rather than getting these sort of higher prices. Does that make sense? So the sequencing of when the sell order goes onto the order book, then it's ideal for trader 1 and 2 that the sell happens first, and then the sell order, which is actually a limit order, which will sit on the book, is now accessible for trader 1 and 2 to trade.
Mm-hmm. Mm-hmm.
Yeah.
Thanks.
Yeah, so that's also a really important one. So I did this very sketchy kind of, very sort of terribly designed sketch, let's say, of how I think centralized infrastructure works. Basically, if we look at a centralized exchange, which is everything to the left of this big green dotted line, and you've got a couple of traders here, and these traders are sending in orders to this, what we call the gateway, this dotted green line. And when they hit the gateway, the centralized exchange's job basically is to rubber stamp it to say, yep, we've received this order. And then what it does with like just one sort of atomic transaction, let's say, is that it processes that order through its matching engine. And that matching engine could be a continuous limit, a continuous trading limit order book, or it could be frequent batch options, which I'll get into a little bit of chat with you guys about in a sec. But yeah, so if you think trader 1 and trader 2 are receiving information, all sorts of information from the world, and attempting to act on that, what's important to note is that trader 2 here, they can't see the contents of what trader 1's orders are, and vice versa. So they can't see each other's orders. They're sent along, some kind of dedicated low latency lines. It's not actually using HTTPS, but it's, yeah, some kind of encrypted lines into the centralized exchange. And so it's really only the centralized exchange that has the full information of what this full order set is. And so I drew a little evil man down here, because I was like, if thought experiment, the centralized exchange was dodgy, they would get all the information to all these orders. And in fact, they get to rubber stamp the time on them at any time. So they could kind of say, oh, no, you know what? If they favored trader 1, actually trader 1's order came in first before trader 2's order. Or they could, even worse, and that's why I've got this little arrow here, inject their own order into the matching engine. And none of these traders would be any the wiser, because they don't know what the data flow and what other traders in the market are doing. So one thing that the centralized exchange also does is it then broadcasts out the information of what orders have happened, what trades have happened, and it provides to each of the traders an execution report on that rubber stamp of, that time stamp of this is when we received your order and this is the consequence and what happened to it. This data is super important for understanding where the market is, because these traders don't have full visibility into this flow of orders. This is how they learn what's happening in the market. If the market's going up, if it's going down, where the volume is accumulating on the order book. And so something that really kind of gets to me is that you actually have to pay quite a lot of money to get this live data. And I've put I think, the normal retail consumer looking on like the CME or the London Stock Exchange or whatever has something like a 15-minute delay window. So you can't do any serious trading with 15 minutes delay. The whole market's moved on before you even know what's happening in the market. And so I put a little long line out here. This is the sitting ducks out here of all the people trying to trade when there's this, complete asymmetry of information flow. So that's just sort of in general how a centralized exchange infrastructure works. If you guys have any questions on that.
Yeah, I mean, this is interesting. I'm trying to tie back the analogy. So what's the matching engine in the blockchain context? Is this the miners who are
No,
effectively...
this would be like the miners, although I don't want to put an evil face there for the miners because they're very good, honest miners, obviously, is what we're counting on. But the job of the miners will be to collect these transactions as they come through and push them into the matching engine. And so if they collect them and push them through in the order they receive them, I mean, that's sort of ideal, right? That's the sort of honest. Actually, I've drawn a little diagram here of how it looks in a decentralized infrastructure. So you've got a couple of nodes here that are the miners. And after the job of the miners is to essentially their main job is to, well, their only real job at the consensus layer is to publish that block. And if you're using any kind of matching engine whereby your relative sequencing in that block matters, like a continuous limit order book, like I just showed you, of like the differences that could occur depending on the different sequencing, then that really matters. So once they've proposed that block, then that will go into a matching engine, whether that's a limit order book or a frequent batch auction or whatever.
Got it.
Yeah.
Okay,
cool. And so actually, since we moved on to the decentralized infrastructure, I'll just take you through. So the way I sort of look at it, and Klaus, I'm pretty keen for you to weigh in here if you've got anything to say on this, but I was sort of mucking around in my head how I think about it. So in a kind of proof of work environment, you have this competition where a miner, sort of wins the right to create that block, and sort of the definition of honest in this situation is that they have full discretion on the ordering. And in fact, there's even, their incentives are, transaction fees where they might then, sequence some of the, transactions above others just based off that.
In the sense, they don't need to attack the system. There is no fairness by design, essentially. It's a capitalistic fairness. Whoever pays most wins.
Yeah.
And if the miners act in their own interests, then that's what's implemented. But nobody tells the miners to process orders anywhere in the sequence they saw them.
Yeah.
And capitalistic fairness, that refers to how Ethereum does it today.
Yeah, well, in Bitcoin it happens too, right? When the big crash happens, then people that could pay miners to be processed first won, and small investors probably had a hard time getting the Bitcoin sold.
Right.
And
but is there an argument around like, why don't we just believe in fair market and leave that as a function of the market for it to resolve itself?
it's a valid system. It's just not applicable if you want to do real trading. Then if always the trader that has the biggest purse wins, probably a lot of smaller traders will just abandon the system and not trade there anymore.
Yeah, and I'd say another thing, like something that was important to us in designing Vega, is we wanted people to be able to place orders on our order book without paying to place those orders, because that's really valid market information that builds out the order book and makes volume and liquidity available to other traders. So yeah, I think sort of removing that is actually sort of a very deliberate design decision from us. Yeah, to sort of
one thing we're seeing now, and I'm not sure how related that is, that on Ethereum the price per transaction is going up. There seems to be some bottleneck. So this
well, that's the other thing, exactly. Yeah.
On how high the fees go if everybody wants to trade, and that's in the end bad for the entire system. If the miners are unlimited in how much they can charge, and as soon as there's a bottleneck, then the miners say, "Hey, cool, I can triple my prices." So, yeah. As in the real world, capitalism is great, but having some regulation around it to control it is probably a very good idea.
Yep, that makes sense. And it sounds like we're kind of transitioning into the discussion. So, Tamlyn, was there anything else that that you wanted to point out before we kind of.
No, that's, yeah, the rest of this table is really just about sort of looking at proof of stake models. So I guess, you know, in normal proof of stake blockchains that I know of, where you've got like a rotating leader node, again, you still have, the block producers have full discretion on the ordering of the transactions. But what I guess one of our very early requirements right from the start was that honest actually equals the sequencing as you've received them. And also importantly, only transactions that have been gossiped and seen by other nodes. Otherwise you get the situation where, I mean, the market's moving massively. We've already seen that happen a few times this year. And then, you know, as a miner, you might be then incentivized to put your mate or your mates, you know, suddenly mint some new transactions of your own or for your mate, just to sort of shove them into the block, which is also obviously not ideal for fair market sort of trust and so forth. So the problem that we really had, we had that as a requirement, but, and we say this, well, we want for honesty, and we're hoping that, you know, miners who are building, or validators, sorry, who are building kind of a business and doing validation and understands the way they're meant to operate, is how they're going to operate, but it's really, really impossible to prove compliance. And I think in a way that kind of just makes us as good as the centralized exchanges, in that you're sort of trusting that the business operations and the sort of legal infrastructure around you is sufficient. But that wasn't, it just never sat fully comfortable with us. And so, yeah, introduce.
One difference is in the centralized system, you need to trust one centralized party, which of course we're all in this area because we want to do this.
Yeah.
But in the decentralized system, if you're not careful, you need to trust all validators, because anyone who becomes the leader could now cheat on the order, and that's even worse. And one approach people have been taking is that they replace the leader very rapidly. So the real world analogy would be that you have a new president in your country every week. So if you have a bad president, you can mess it up for a week and then you get the next one. But that's also, if you have a bad leader, they still can cheat while they're the leader. So the price of decentralization is the whole system is more secure, but now some bad guy may actually get into the internals of your system, and there's usually no code reviews or financial authorities that control your system. So some attacks are actually getting easier by opening us up to a decentralized system.
That makes sense. How much do traders care? I mean, what's the persona of a trader who would value this? Because if I'm placing one trade a year, I might not care what happens because I'm not doing high frequency. And my sense is the folks in a blockchain context, like I don't know how often they trade. So how much is fairness a concern to traders that aren't placing a high frequency of trades?
So it's a really good question. And actually, I've been really looking for some sort of global deep research on this. And the FCA put something out earlier this year. They did some research. I think they did it along with Chicago Booth guys who've been looking at market microstructure and actually really favor the frequent batch options as a sort of alternative to limit order books. But in any case, what they did is, you know, they looked at that gateway and that message data. Basically, I think they managed to get a whole bunch of that data off the London Stock Exchange. And it was just for one market. I think it might have been just stocks on LSE, but they found that there was something like a 17% increase in price for your normal investor, like not your high frequency trader, as in they could have got 17% lower, paid 17% lower than what they did over the course of, you know, the time period of the study, which I thought was really interesting because it's been difficult to find information, sort of find research that really looks at this because of the obfuscation, obviously, around a lot of the data.
Got it. So it still translates into higher costs for the trader, because anytime you place an order, there's an opportunity for someone to potentially front run you and get a better execution price.
Yeah, basically, it's a sort of, you know, there's a big arms race where the sort of more tech, more microwaves, more other creative sort of things that you do can get. It's that, like I said, like every person trading may have the exact same access, like symmetrical sort of receipt of the information, but translating that into access to the order book is where the real challenge is.
Mhm. That
We
makes
also
sense.
may create a completely new scenario here. So right now, if I'm trading one time a year, I will have so slow access that I don't care anyhow, because one way or the other I lose against the professionals. And if we now open up and have a blockchain-based solution where everybody has equal conditions, then maybe I care more, because now I have the feeling I'm actually part of the game. So now
I think that's a really, really good point. I mean, there's a huge separation between professional sort of trading world and regular people. And the only place I've ever seen the real bridge is in crypto. And people, you know, sort of people going, actually, no, I want to look after my own, you know, have sovereignty over my own finance. And that isn't just exchange of value, that's exchange of risk. And yeah.
That makes sense. Okay, I think that was a really helpful explanation around kind of motivating the problem. And obviously, Klaus, you've talked about this in the context of your paper and kind of different approaches to solve this. But you had some really interesting content there, really taking a step back and defining what fairness is, because I think throughout we've been talking about this word, but I don't think there was a clear baseline around what it is. And in your paper, Klaus, you had several definitions. So can you give a kind of high level comparison between those, and also talk about specifically which one you are proposing to implement in a blockchain context?
Sure. So, well, the big problem with fairness is it's a totally over-defined word that people had the different meanings for that for the last 30 years in this context. So originally, fairness means that if what's now censorship resilience, that if I put in a transaction, it's delivered in a reasonable time. What we care about here is order fairness or relative fairness. So we want fairness not in an absolute time, but relative to other people. And the initial goal, what we were aiming for, is that I, as a trader, send something to every validator. And if all validators see my transaction before Tamlin's transaction, if all honest validators see my transaction before Tamlin's, then mine should be executed before hers. So that's a sort of intuitive definition where everybody would agree that's probably a good idea. Unfortunately, we can also prove that's impossible to do. That's been parallel done by us and by University of Cornell. So the thing we actually really would want is something we can't get. So the next best thing is, and then we are aiming a little bit for batch processing. If all honest validators see my transaction before hers, then at least I end up in the same or an earlier block. And then we can have the matching engine sort things out. That is possible, but that may, in a fully asynchronous network, lead to big blocks. So we need a bit of compromise to make that work. But that's one model that we propose to use. And the next weaker definition that we can definitely do is a timed version. So all validators have a clock, and they say at what time by their local clock they saw a transaction. And if there's a time T, so that everybody saw my transaction before T and Tamlin's after T, then mine needs to be scheduled before hers. And that's something we can easily implement. And we're now working also on other definitions. So have some priority things that, for example, cancel orders are treated differently than normal orders and are outside of the fairness regime. And what the protocol will do is it allows market makers to define, to set their own sense of fairness. So I mentioned those two, the timed and the block fairness. So a market maker can decide, for my market, I want that fairness, and then the fairness is implemented only for this market, since we don't need all transactions that are processed to be fair relative to each other. If somebody has a derivative on the prices of bananas and somebody else on the prices of Teslas, then probably those markets are unrelated and we don't need them fair with each other. So whoever builds a Tesla market can have a different sense of fairness than who builds a banana market. And what we're aiming for now, so that's two definitions that we know work. We know the perfect definition we can't implement. So we're now reaching out to traders. Can we have other definitions that you would like? Would you like a more capitalistic thing, that we have sort of controlled capitalism, that you can still buy a priority lane, but if somebody doesn't pay, they still don't get disadvantaged too much? So maybe that's something market makers want, maybe something we haven't even thought about yet. So in this, we are now actively reaching out to the community, tell us what fairness you want, and then we can see if we can implement that. And the protocol is now changing in a way that we wanted to add as many different fairness definitions as possible and be more a framework for different senses of fairness rather than providing only one definition.
Yeah, and I'd say that those are really bolted. Like the idea of what's fair is very, very, very linked to whatever the price determination method is. So whether if it's a limit order book, you want the very, very tight sequential ordering. Whereas if you're doing a frequent batch auction, the fairness is more about, are you included in that batch or the next batch? If that makes sense. And, if we were to ever look at other price determination methods, we'd probably want to relook at fairness in that way. And the fact that Klaus is saying that we have a flexible protocol that we can define fairness according to the market needs is really cool, I think.
Yeah, that's interesting. I'm curious on timed fairness. How does that work in a blockchain context where validators have their own, each one has their own state of the mempool, and each one receives transactions at a different time and have different local clocks?
Well, that's why we need to have it in a way that if all honest saw it before time t according to their local clock, then we can guarantee it's scheduled before the other transaction.
But what if there's a validator who doesn't yet receive a given transaction in their mempool, and they can't determine that? So then do you have to wait until all the given validators?
The first thing the fairness protocol does is, if a validator sees a new transaction, they immediately send it to all other validators to make sure all of them have seen it. And if some of them are slow and get some messages slow, if they're honest and get it late, then that's a problem of a decentralized system that's hard to avoid. So generally, not everybody who can is dishonest. So generally, a couple of slow people are easily compensated if you have the fully tolerable corruption. So 1/3 corrupted parties and then others are slow. The protocol still works. If your clocks go very, very differently and the adversary can delay messages arbitrarily, then of course the whole concept of timed is getting a bit difficult.
Totally. But yeah, and it sounds like there's a trade-off around latency where it seems like there's a trade-off between latency and fairness, where if now you do need to wait for all these transactions to propagate, then that might affect the trading experience as well. So how do you think about that trade-off in like the right kind of fairness to implement?
Well, I think that so it is of course a trade-off, so you lose a little bit of latency on that part. However, every blockchain, the best blockchains possible, have still 3 or 4 rounds of communication. So we add 1 to this. So in this, the loss is not that bad. What may have a bigger impact that sometimes you have a transaction where you just don't have enough information yet to say, am I allowed to schedule this, or would I create an unfairness if I schedule it now? So we also have some latency by just having to hold back some transactions until we have enough information to know what's happening with them. And that would be next step, which we haven't done yet, to run simulations to see how big the impact actually is. And that's why we separate in different markets. So that banana transaction doesn't need to wait for the Tesla transaction. So the waiting is as minimal as possible, but that also has some impact on latency, and that's unavoidable.
Mm-hmm. Mm-hmm. That makes sense.
Given the normal blockchain performance, I think it's tolerable. So most blockchains people use right now are actually not optimized for latency either. So we still have a lot of ways there to improve things, and I think we still can easily stick to below a second.
Mm-hmm. Got it. Great. And it sounds like, and correct me if I'm wrong, but the implementation in a blockchain context for quote unquote fairness is proposing a pre-protocol that runs in parallel. But could you maybe talk about more concretely how that implementation would look like?
Yeah. So the idea of the pre-protocol is that we don't want to rebuild the entire blockchain, but we want to have, and that's why it's actually called Wendy as the best friend of Casper, which is a post-protocol for Ethereum, and Wendy would be a pre-protocol that could work on Ethereum, even though it's meant for Vega. And essentially that protocol sits between the traders and the blockchain. So rather than sending it's the same validators, but rather than sending a transaction straight to the mempool, it's sent to the mempool of the pre-protocol. That one assures a fair order, creates a block of transactions that need to be scheduled together, and then gives this block as a whole to the mempool of the underlying validators. So we're also trying to keep the interaction with the blockchain as a minimum. So the two interactions are things don't go straight to the mempool, but it goes through the pre-protocol, and then we put a block in the mempool. And we need the block validation function that determines if a block is valid, also now needs to take into account fairness. And otherwise, we don't need to touch the blockchain. And that's also another big goal of our implementation, not only of the fairness, but of everything we are doing, that we want things modular, that you can replace one component and the rest just essentially stays. So even if we add other things like spam protection or commit and reveal, which is another thing people do for front running, that has very simple, straightforward interfaces, and you can plug it in, out, and replace it without a too big headache. Of course, the people that have to implement it may disagree here and tell me it's much more complicated than I wrote it down.
Oh, that's interesting. I didn't know that there was a separate like pre-protocol mempool. So then you send. Let me rephrase. Does that mean that the mempool for the validators now becomes a mempool of blocks rather than a mempool of transactions?
Yes. So that's how the fairness works. It essentially says these 5 transactions need to be in the same block, otherwise you are unfair. And this block is then given to the mempool and should then go into the next block of the blockchain.
Got it. Okay, that's
helpful. We're having a lot of discussion on the implementation, if we need some virtual blocks, or if we just say the maximum fairness block has to be so much smaller than the actual block of the blockchain that just fits in. And that's the implementation details we're still hammering out, why implementing it is not quite as trivial as writing it down on a paper.
Yeah, that makes sense. And do you have a sense of how this implementation of fairness addresses some of the issues we've seen with kind of spam transactions, where potentially malicious traders or validators, they will send a large volume of transactions into the mempool, potentially with the same gas price or even and again, this is like Ethereum context, So there are potentially some analogies here. But setting it with equal or lower gas price where you know it won't be included in a block, but you're kind of clogging up the mempool and causing those validators to drop some of the transactions that are not malicious. And so you have this issue around spam. Mm-hmm. So how does that get addressed by having a kind of fairness ordering from that perspective?
So the fairness protocol addresses this to a very limited amount. What we're also working on is a separate spam protection. And the idea is if the same trader sends more than random number, 100 transactions per second, then they need to do proof of work for the next 100 transactions, and then a more complicated for the next 100. So that ideally, if I try to spam the network, I have at some point I need more computing power than I get value out of spamming the network. That's not part of the fairness. There's a little bit of spam protection the fairness protocol gives, but essentially this would be another building block that would then be put on top of the fairness protocol to weed out these kind of transactions.
Mm-hmm, mm-hmm. That makes sense. Great. I want to leave some time for Q&A from the audience. We have
one question in the chat, right?
Yeah. So if there are other questions, please throw them in the chat box. Wolfgang had one that asks, isn't the incentive for node owners in a decentralized network to conspire much higher than for a centralized exchange? Because the centralized exchange has more to lose. Mm-hmm. So I don't know if Tamlyn have any thoughts on like what, like why would a, I mean, it sounds like you were alluding that centralized exchanges do this.
Oh no, I don't ever want to imply that. I most certainly don't. But there is no proof that they don't. And in fact, I asked one of my friends who runs a very large, very under the radar HFT company in the US, and I asked him about this. I'm like, do you guys really trust your centralized exchanges and non-crypto? And he said, look, the only reason we do is because of regulation and hard enforcement of the regulations. So he's like, broadly we do, but we also do everything we can to get the advantage, whether that's becoming a member or like whatever we can access sort of legally through the system we do. But to answer Wolfgang's question, that's an interesting one, because I'm not quite sure I see it quite like that. I'm not sure that they do have more to lose. I mean, if you think about a decentralized network, if Vega, for example, were to one day run like very serious traditional markets, our node operators should be receiving, very high sort of income instead of the fees going to a centralized operator. And, within a geographical boundary, we hope to be running a sort of global network that's, as Klaus alluded to earlier, sort of building the pie, because there are more people who can access trading because of the fairness and access and a whole bunch of our other design decisions. So what I mean is the classical front runner is the market maker who might lose their business when caught. The node owner does not lose more than a node. I mean, if their business is running nodes, do they not lose their entire business and access to that revenue? Especially if they've built that business over time and their reputation, and depending on our staking model, what that implies. Sorry, I wish I could turn on the voice. I don't know if I can.
Also to add on this, so if an individual node owner could cheat, and that's why we're doing all of this. So if I can have one node and I can cheat without being caught, then yes, I have a high incentive, and the probability that out of 20, 30 validators, one of them would like to cheat is probably higher than for centralized exchange. But that's why we have those protocols that you now need at least a third of the validators to get anything cheaty done. So even if an individual validator has more incentive to cheat and even more possibility, you now need a conspiracy that gets a third of your validators coordinated. And anyone who ever tried to organize a surprise birthday party, that kind of conspiracy is very hard to pull off without being caught. And so we are trying to disincentivize them by showing them it's futile unless you get organized with a lot of other validators to be corrupt. And then we get into the staking model, how we can also try to make this more unlikely, and validation that there's some level of detection we can do if somebody did try to cheat, that they lose all their stake, and try to get the limit on how possible it is to cheat as high as possible, that at some point people will just say it pays off better to be honest, or I just can't pull it off because I can't organize 2/3 of the validators to collude with me.
That's interesting, and it also points to the thought of for protocols that don't have this as a feature in the base layer today, how desirable is it for validators or for miners to actually want to I guess comply with a particular notion of fairness, where if you want to for example implement the pre-protocol on a blockchain that's already on mainnet, it sounds like that would require a user activated soft fork to actually implement.
No, it wouldn't need a fork. So it can be added to a protocol, and you need to change the definition of what it means later on for a block to be valid. But we could technically add this to Ethereum now and keep the chain alive. It just would mean there's now blocks that are marked fair and they need an additional verification how that works. To the other part of the question, that really depends on what the higher level application is. Like on Ethereum, there is no concept of fairness, so all the validators have no rules. They can choose freely what they prefer, which order they put the transactions in. So they have no motivation to cheat because the whole concept of cheating doesn't exist. But that does mean there's certain things you probably wouldn't do on Ethereum that you would do if you had some fairness. And for other exchanges, I think Tamlyn can say more.
Yeah, I was just going to make the point, actually. I think, we've always talked about designing our blockchain for trading, and there are probably other applications. I can't think of any off the top of my head, but I'm sure there are, that also sort of require sort of this kind of definition of fairness and sequencing and ordering. Yeah, it makes a lot of sense to me to have I don't know how to say this, but like if a group of the existing kind of financial applications that cared about this were to ask for it on Ethereum, I guess that could be a solution, or they can branch off to have another blockchain that just customizes and sees, a bit like we do, sees things at a sort of market level, and so that we can customize our fairness to be for one market or for another. And then, can sort of run many different types of markets with different price determination methods and so forth. But I'm not sure if that's answering your question, sorry.
No, I think that's helpful. Yeah, I think we have time for maybe one or two questions from the audience. So maybe I had one more on my side, and hopefully someone will chime in. But a lot of this conversation has been talking about fairness in the context of order books. And Tamlyn, you mentioned this in the beginning around automated market makers, constant function market makers. How do you apply this into kind of like that world of quote unquote trading?
Yeah, I think, it's definitely the sequencing of accessing an AMM is also very important. If someone brings in a large buy order, there's a predictable price path of where that's going to end up. And then, someone who wants to sell is obviously going to prefer to come after that buy order. And I think we see a lot of the sort of fun and games around AMM stuff. So I think it's actually all pretty similar. I would probably want to think a little bit more. I haven't sort of delved super deeply into AMMs to think about whether there'll be anything else, any other kind of market fairnessy requirements that you might want to add in. I'd be really interested to hear from people who, you know, mechanism designers who this is their thing, and we probably should reach out to some of them and have a chat to them about it. Because I do think that different price determination methods might bring in different sort of insights for us. But other than the fact that, yes, obviously the sequencing really matters, yeah, I don't have too many more insights than that, other than I think it matters at sometimes more than a continuous limit order book.
Yeah, that's a good point. And I think you've seen that with a lot of the initial listings on Uniswap, and maybe it's more of a question around latency as well. But you've had I don't know if you call it front runners, but effectively you have traders who buy a large portion of the asset very early on, and proceed to sell it after everyone else kind of piles on and raises the price even more.
Yeah, exactly.
Yeah. So one more from Wolfgang to Klaus around what you mean by timestamp.
Okay, maybe first the previous comment Wolfgang made, so that would be a totally different conversation now on staking models and how we try to prevent that, which maybe is the next webinar. The timestamp is set by each validator by the time they first see a certain request. And of course, we would like to have a model where the timestamp is set when a trader sends a message, but then we need some trusted hardware to do secure timestamps, and we can't assume that exists. So the best thing we have is first time a validator sees is the timestamp that validator gives that request or that transaction.
Great. I'll wait 5 more seconds for any last questions in there.
Type faster.
Okay. Well, I think that's it. Hey, this is super fun. I personally learned a lot. Thank you for the discussion and insights, and I feel like we could go down this rabbit hole for another few hours. But for those watching, if you do want to discuss more, feel free to continue the discussion at community.vega.xyz. I think we've seen that Klaus and Tamlyn aren't afraid of the difficult questions. So I would encourage everyone to continue to share their thoughts on there. So with that said, yeah, thanks again, Tamlyn and Klaus, and looking forward to speaking soon.
Thank you, and also thanks Wolfgang for the questions.
Yeah, thanks everyone.
Thanks everyone for joining and watching.